All right, so here's our video on predetermined overhead rate and how to apply it. So we've kind of laid the foundation in some of the other videos already about some of the other managerial accounting concepts like cost behaviors, and so variable versus fixed versus mixed. We've talked about the cost flow assumptions, so basically how do costs flow through a company, which can be different for a manufacturing company and a service-based company. So you can, with a manufacturing company, you'll have things like basically the journey is all the way from our raw materials to, what is the cost of our finished goods at the end of the process, and how do those costs flow all the way through the company. So we established in those first few videos that whenever we talk about the cost of something, we're really going to, in terms of this course, we're going to think of three things. What are the direct materials, what are the direct labor, and what is the manufacturing overhead? And if we can track those three things accurately and efficiently, then we can answer the question, what does it cost us to do what we do? Now, in this video, what we're going to talk about is the predetermined overhead rate, because more and more manufacturing overhead is becoming a huge chunk of the cost of any company. So we have to figure out, how do we allocate that out? Because if you think about manufacturing overhead, basically what happens is we have this account. It's called overhead. Manufacturing overhead, service overhead, whatever you want to call it, but it tracks or it collects all of those indirect costs that are required costs to do what we do. So if it's production, it's things like the depreciation on our production equipment. It could be maintenance on the facility. It's property taxes. It could be depreciation on the building in which we work. So all of these are costs that we actually need to be able to operate, but they're not directly related to, say, making a bicycle. Right? So they're not direct materials. It's not like it's the bike frame or the pedals or the wheels. It's not direct labor. So it's not the person that's directly assembling the bicycle and getting it ready to sell. But these are all of our ancillary costs that are required to get the asset into a get our inventory into a position to sell. Like, we couldn't operate without these things. They're still a product cost, but they're not direct. So the question is, well, how do we allocate them out? Right? And in terms of job costing, when I'm costing a specific job, it's easy for me to come up with materials and labor from my materials requisition forms and my labor time tickets. But the question is, how do I get overhead? How do I charge overhead to that job? And the answer is with the predetermined overhead rate. Now, there's a few things that are pretty unique about the predetermined overhead rate, one of which is the timing. So basically what we do is at the start of the year, we estimate what our predetermined overhead rate is going to be, which means that it's our predetermined overhead rate, when we calculate it, is always going to be based on estimated overhead and some type of estimated activity base. So you can see from this slide right here, there's actually three activity bases that we talk about. There's direct labor cost, there's direct labor hours, there's machine hours. Those are probably the three most common, especially in a traditional costing system, that you would use to allocate out overhead. Okay. Now we're going to go over the formula here in a second as to how to calculate it, but what we need to lay down here is the foundation, the understanding of why. So the reason this is done at the beginning of the year, I'll give you an analogy or a situation. Pretend that you are the manager of a job, okay? And so you're building a high-rise complex, okay? So you're building a high-rise complex. You've been working on it for a year and 3 months, and it's coming to closure. Okay, so it's going to finish at the end of this month, right? Now, if we didn't have a predetermined overhead rate, what you would have to do as the manager is you would have to wait all the way until the end of the year. And let's pretend this is the end of February and our year end is December 31st. If we didn't use a predetermined overhead rate, you would have to wait all the way until the end of December for me or the accounting department to be able to tell you what was the total cost of your job, because you would know your direct materials, you would know your direct labor, but you would have no idea how much overhead was being applied to that job. So you couldn't answer the questions. Well, what was the total cost of the job? Did I make any money on the job, right? And then what happens if in April we have to bid on a new construction project that's very similar to this one? Well, we don't know our costs. So the issue is we can't wait. So we have to come up with a way to allocate overhead to the job immediately, as soon as it's done or as we're working through it. And that predetermined overhead rate allows us to do this. So it's based on budgeted numbers. So before the year even starts, we sit down. So before the year, sorry about that. So before the year even starts, what we do is we sit down and we put together our budgets and we estimate what is our overhead expected to be for the year. And then we select one of these drivers, these activity drivers. And now these activity drivers are things that are a huge part of our operations and things that drive those overhead costs. So if we're highly mechanized, we're probably going to use machine hours because that makes sense. If we are very labor intensive, then direct labor cost or direct labor hours might make more sense. So we pick one of these activity cost base or these activity drivers that fit our needs or that suit our company, and what we do is we take our overhead and we divide it by that driver, and what that gives us is a rate. And so let's pretend that we used machine hours. Okay, so here's the formula right here. Estimated annual overhead divided by expected annual operating activity. That's that estimated activity driver there, that second one. That gives you your predetermined overhead rate. So let's pretend that we decided to use machine hours as our expected annual operating activity. What we would do is when we finish the budget, we would take our estimated annual overhead costs, and let's pretend they were $1 million, right? And let's say that we were expecting 10,000 machine hours on the year. So $1 million divided by 10,000 machine hours is what, like $100, right? So $1 million divided by 10,000 is 100, right? Whenever you're doing this calculation, it makes a lot of sense for you to reiterate in your mind or even write on the page what that number means. So $1 million in costs divided by 10,000 machine hours equals 100. But it's 100 what? 100 chickens, 100 squirrels, right? What is it? It's 100 something. And what the answer is this is $100 per machine hour. So from now on, for the rest of the year, every time a job or every time we use a machine hour for a specific purpose, we're going to charge $100 worth of overhead to that job. So if I use 10 hours, well, I'm going to do 10 times 100, and I'm going to charge $1,000 of overhead to that job. Okay? But always remind yourself, when you calculate this number, estimated overhead divided by the estimated activity driver, and you get a number, remind yourself what it is. Is it $100 per machine hour? Is it $100 per direct labor hour? If you're doing direct labor cost, it's going to be based on a percentage. So it's going to be 160% of direct labor cost, right? But it makes sense to write that out just so that you don't confuse yourself as you're working through the questions, okay? So that's basically how you calculate the predetermined overhead rate. We're going to do an example here, and we're going to walk all the way through it, but I want you to understand how it was calculated, the timing of when it was calculated. One other thing to keep in mind is that that predetermined overhead rate is based on estimates, and no one has a crystal ball. So there is almost a 0% chance that the amount of overhead you apply by using that overhead rate, and then the amount that you actually incur, which is the amount of real dollars you spent on indirect labor, on indirect materials, on rent, on hydro, on maintenance. So the real money that you spent, right? That's what we're trying to apply out using that overhead rate. Well, the chances that we apply exactly the amount of money that we paid out are very, very slim. Okay, so what you're going to end up with is you're going to have a year-end balance in your overhead account. You got to get rid of it somehow. The easiest way is to actually get rid of it to cost of goods sold. So basically, if you're under-applied, you're just going to charge it out to cost of goods sold as a debit. And if you're over-applied, meaning you've applied more than the real dollars you've incurred, you're going to credit it to cost of goods sold. Because if you think about it logically, that's where all these costs end up anyways, right? Labor, direct materials, direct labor, and manufacturing overhead are all product costs. They're all sitting in our inventory, right from the raw materials phase through work in process and then into finished goods. And then when we sell them, they go from finished goods and they become cost of goods sold on the income statement. So eventually all of these costs are getting to cost of goods sold anyways. So that's the easiest method. Once you have, if you've got a year-end balance, the easiest thing to do is to allocate it out and adjust it out to cost of goods sold, right? There is another method. It's called there's a prorated method where you can put some of it to your inventory and you can put some of it to cost of goods sold. But for the purposes of our video, we're just going to focus on allocating it all out to cost of goods sold. All right? Okay, so let's look at how this works then. We've got an Excel question that we're going to work through together as a group here. Okay? At the very top of this Excel question, you can see here that I've got three distinct steps that you have to go through with your predetermined overhead rate. Okay, so anytime you get a question, you could see a question that asks you any phase of this. So the question you're looking at could very simply just say, hey, calculate the predetermined overhead rate. And all you need to do is step one. Pretty simple, right? Alternatively, you could be provided with a bunch of given information, right? And it could only say, determine if overhead was over or under applied and close out the difference to cost of goods sold. So it could only be asking you for step 3, but in your head you have to know that, hey, I can't do step 3 unless I've done steps 1 and 2. Right? So here's what we need to do. The first thing at the very beginning of the year, day 1, we are going to calculate our predetermined overhead rate using the estimated figures that are given. So that's estimated overhead divided by the estimated activity driver. And the question either will tell you what the activity driver is or will give you some options that you would have to pick from a list of what makes the most sense. For the most part, at this phase, we're probably going to be giving you the estimated the estimated activity drivers. Okay, so that's step 1, done right at the beginning of the year. Step 2 is to allocate overhead, and how do you do that? Is you take the predetermined overhead rate from step 1 and you multiply it by the actual activity driver. And we already talked about this. So in the quick example we did before, we said we were going to use machine hours as our activity driver. So once I calculate my predetermined overhead rate in step 1, when I get to step 2, I just take that rate and multiply it by the actual machine hours that are used on every single job. Right? That's how it works. And then the third and final step is to step back at the end of the year, take a look at all the real costs that you had incurred and compare it to all the overhead that you allocated using this predetermined overhead rate. And if you allocated more than the real costs you incurred, you're over applied. If you allocated less than the real costs you incurred, you are under applied. And then you just close that difference out to cost of goods sold. Okay? So let's use the information below and let's walk through those 3 steps. So in this question, I've got estimated overhead costs of $840,000. I've got actual overhead of $861, estimated consulting hours, and then actual consulting hours. Okay? So in this question here, what we're going to do is we're going to use the consultant hours. So basically this is like direct labor hours as our activity driver. We're going to use those as our base, as our activity driver. Now here's one thing that might help you when you do a question. Sometimes in an accounting question, you're given a ton of information and it's really hard to sort through it all. So what I like to do is basically, as I'm working through it, highlight what I need to look at right now. And I know that step 1 of my process, right? So we're going to use, again, this question saying determine whether overhead was under or over applied. We're doing the very last step, but we have to go through all 3 to answer this question. So step 1 is determine the predetermined overhead rate. When I do this, I know that I am using my estimated figures. So I grab my estimated overhead and I grab my estimated consultant hours. So 840,000 divided by 40,000 is going to give me my predetermined overhead rate. I do this right at the start of the year. So if this was a calendar year, right? I'm going to do this on January 1st. I'm going to come up with this rate and then I'm going to use it for every job that I do throughout the course of the year. All right? So I've got estimated overhead of 840 and estimated consulting hours of 40,000. So to get predetermined overhead rate, what I do is I take my $840,000 of overhead costs and I just divide it by those 40,000 consulting hours I'm expecting to work, right? And the number we come up with is $21. Okay? This is the point where you got to tell yourself, what does that $21 mean? Right? And because we divided our costs by an activity driver, right? And in this case, it's decorator hours. This $21 represents $21 per consultant or decorator hour. Okay, this is consulting, so it's consultant hour. So now I know that for every job that I do for the rest of the year, I am going to charge $21 per consultant hour. Okay, so if I use 1 hour on a job, I charge 21 bucks of overhead, in addition to any materials and labor. But this is how I allocate out my overhead. Okay, so that's step 1. Take your estimated overhead and divide it by your estimated activity driver, and that will give you your rate per either hour or per dollar of labor. In this case, we're doing consultant hours, so it's $21 per hour. All right. Now, step 2 of the process is allocate overhead based on the actual activity. So all we're going to do now is again, let's grab the relevant information. So I'm done with this, right? So I don't need this anymore. So I can kind of hide this, and if I wanted to, I could strike these numbers out. I could kind of cross them out because I really don't need to see them right now. I'm done with them. Now what I want to do is I want to take that $21 per hour, right? Because I know that's my predetermined overhead rate. I'm going to charge overhead based at $21 per hour based on every actual consultant hour that I used over the course of the year. So if I scroll back up, you can see that we actually used 41,500 consultant hours for the year. That's actual. Those are real hours that we used. So what I do is I take my 41,500 and I multiply it by that rate per hour, the predetermined overhead rate from step 1. So this is how I'm allocating. So as I'm working through the year, basically all the real hours I'm using up on all the different jobs and the things that I do, I've incurred 41,500 hours, so if I charge overhead at the rate of 21 bucks an hour, that makes my allocated overhead $871,500. Okay? So that's step 2. The question we're trying to answer, and it's always important when you're answering questions to kind of scroll back up and say, hey, what did they ask me? Have I answered it yet? So what they've asked us is, let's use the information below and determine whether we were over or under applied. So in this case, we haven't answered that yet. We said what the predetermined overhead rate is. We said what we applied, but we haven't said whether or not this was more or less than what we actually incurred. So the third and final step is to determine if you are over or under applied. And what we're going to do is we're going to take a look at what we applied, which in this case was 871,500, and we are going to compare that not to the hours incurred, not to the estimated hours. We are going to apply that or compare that to the actual overhead costs that we incurred. So this here, this is the real dollars. This is the real money, the real charges that we incurred over the course of the year. So what we paid for rent, what we paid for supervision, maintenance, the depreciation that was charged on assets used in the manufacturing process or in the service business, right? Those are my actual real costs. So in this case, we applied 871,000, but we only incurred real costs of 861. So you can see that we applied more than we incurred, and therefore we are over applied by $10,500. Right? So in this case, we are over applied. All right, and that's your 3-step process. Now your responsibility is, even if I just ask you for this 3rd step here, you have to understand that you have to go back through the first 2 steps to answer this question. Okay? But those are the 3 defined basically steps, and even though the textbook might not break it out and say, hey, this is step 1, this is step 2, this is step 3, this is effectively what you're doing. Okay? Now, what we just did right there was we took a look at this on the grand scope, on the scope of an entire year. So step 1 at the beginning of the year was come up with the rate. Then over the course of the year, you allocate costs out to all your projects or all your jobs, and this is the total cost you allocated, $871K. And then at the end of the year, you decide whether you were over or under applied, and you close it out to cost of goods sold. But the same holds true for costing out a specific job. Basically, we calculate this rate at the start of the year, and then as we work through jobs, we charge costs to jobs. So let's see if we can do that. We're going to use the same information up here. So we're using this same $21 per consultant hour predetermined overhead rate. And what we're going to do, let me just hide that. What we're going to do is we're going to try and cost out a specific consulting job. So this just is one of the jobs that we started up during during the course of the year. Okay? So the question is saying, what would the total cost of a job that required 78 consulting hours be if consulting hours are billed out at a rate of $90 per hour? So effectively, consulting hours not billed out, I guess, if consulting hours are, this is basically paid to employees. So effectively, their hourly rate is $90 per hour. Okay, so we're trying to figure out what's the total cost of a job if we pay our employees $90 per hour for each consult for all their consulting work, and they work 78 hours on a job. Now here's the thing. For managerial accounting, whether we're talking about service-based or whether we're talking about manufacturing-based, anytime someone asks you the question, what does it cost us? The first thing that should pop into your head is direct materials, direct labor, manufacturing overhead, or overhead. Okay, that's what should pop into your head. Now, it's not always going to apply, and you can see in this example right here, we have no direct materials, because a lot of times service-based companies will build in any type of indirect materials costs, which are typically indirect, into their overhead. They don't have direct materials like a manufacturing company does. But that's what you should think of first, is direct materials, direct labor, overhead. Like literally, if I was asked this on a test, the first thing I would do is direct labor, direct materials, and overhead. And then my total cost. That's how I'd set it up. And then I'd basically just fill in what the question was giving me as I needed it. And then at the end of the day, I end up with total cost. But at least now I've framed my question or my solution so that I can answer it easily, so that anyone marking it can understand it, and it keeps me focused. I know I need to come up with labor. I know I need to come up with materials, and I know I need to come up with overhead. Now, in this case here, I'm going to get rid of this. In this case here, there's no materials, so we're only concerned with labor and overhead. So if I'm costing out a job, the first thing I need to do is come up with my direct labor. And we worked 78 hours on the job, and we pay our employees $90 per hour. So 78 hours times $90 an hour means that our direct labor cost is going to be $7,020 for this job. Okay? Now, I also need to allocate out overhead, right? And this overhead is going to be based on a predetermined overhead rate. And what we did in step 1 of the process is we said we would charge $21 for every consulting hour used on a job. This job used 78 hours. So 78 hours times $21 per hour equals $1,890 total dollars in total overhead being charged to the job. So basically what we're saying is, hey, this job used some of those overhead costs. We wouldn't have had to pay for rent and heat and hydro and all that kind of stuff and property taxes and maintenance and if we weren't doing this work. Well, we did some work, so we need to charge some of this overhead to the job so that we can get a true idea of what a job like this costs us. So that when we're either, so for this job in particular, we can say, hey, did we make money on the job? And more so, when we bid on future jobs, we have an idea of what it costs us to do a job like this. So we can bid aggressively if we feel we need to, or at least at a minimum so we can bid to know we're not losing money. Okay? So at the end of the day, this job, whatever job it is, job 101, taking 78 consulting hours would have cost us a grand total of $8,910. And that effectively is how you deal with the predetermined overhead rate. So it's calculated at the start of the year. Step 1 is calculate the predetermined overhead rate using your estimated figures. Step 2 is allocate overhead by taking the predetermined overhead rate from step 1 and multiplying it by the actual activity driver. And then step 3 is to decide if you were over or under applied. Now, you won't do this third step if you're just applying costs to an individual job. That will typically be if the focus is on an entire year or an entire period of time, right? But those 3 steps, that's basically all you'll need to do with predetermined overhead rate. It's that simple. Okay? So that's it for this video. Stay tuned for more. We got other chapters coming up. It's going to be awesome. Cheers.